All right, up next, let's take a look at the big picture here, what's going on in the markets. David Kudla's with us, CEO and Chief Investment Strategist, Mainstay Capital Management. David, nice to see you. Thank you for being here. Look at that. They bought the dips. They did it. You know, there was talk that we were at highs. Last week was the 15th record close for the S&P. We saw the selling that happened, but look, they're buying them back. Your thoughts?
Hi, Nicole. Good afternoon, and thanks for having me on the show. Yeah, what we've seen here for the past 4 months in this tremendous rally for the indexes, the S&P 500 up 22%, the NASDAQ up 25%, and we haven't had any pullbacks that have been more than a 2 or 3%. And we're seeing that again with the pullback yesterday. There's something that might precipitate a pullback, whether it's an immediate concern. We have, of course, the issue today with the bank in particular. But with where we are in the cycle right now and the amount of optimism, sentiment is very positive. There's a lot of optimism about the market. You're right. We get a dip of one day and the buyers come right back in.
Yeah. So at this point now, with the markets, moving towards the highs, you do have the Fed, right, head speaking. You're looking for opportunity not only at home, but also abroad. Tell me a little bit about the investment ideas that you have for international, Japan in particular.
Sure. Yeah. We really have an America first investment strategy right now. And what I mean by that is in terms of our allocation, we're predominantly in the U.S. because that's the economic engine that keeps firing while we see other countries around the world going into recession, including Japan. But what Japan has going for it is a weaker yen. They've recently set a new all-time high for Japan's stock market that went back to December of 1989. I was back wandering around the campus of Stanford the last time that the Nikkei 225 set a high. So now we've got a weak yen, we've got decent earnings and corporate reforms going back quite a while that are really paying off. So Japan is really our most favored position outside of the U.S. India offers some opportunity too. China is uninvestable right now.
Oh, so no China, no Baidu, Pinduoduo, JD.com, none of those, Tencent, you just don't touch them? Why not?
Well, in the area of technology, I think that, we love technology. We love mega cap tech. We stayed with the Magnificent Seven all last year. We've now got what we're calling the Fabulous Four. We took Tesla, Alphabet, and Apple out of the Magnificent Seven. And those four stocks continue to do well, more concentrated in that generative AI. So any stocks anywhere in the world or companies anywhere in the world, they're going to benefit from generative AI. That is the real catalyst right now for seeing companies. NVIDIA is the poster child for that. It is the stock that most represents this hype or hope over AI. But we think AI is real and it's a transformative technology for industry.
Yeah, let's talk more about when you say America First strategy. You're mentioning tech. Tell me about some of the names, or it sounds like tech is definitely in there. America First, tell me about that strategy and maybe even name some names or groups.
Yeah, sure. We're really what we're looking for. We're large cap over small cap. We are growth over value. And we're U.S. over foreign. That really defines our strategy. So within the United States, we're heavily biased towards large cap and specifically large cap technology. It is an area that just continues to grow. When we look at the Magnificent Seven last year, 60% of the earnings growth for the Magnificent Seven for the S&P 500 came from those stocks. Now we've seen some broadening out now into other technology names, and we think that's where every investor should be overweight and continue to be. We know there's concern about how far those have come. Some of the stocks are these mega cap tech stocks have PEs in the 20s, 30s, even 40s. But as a growth stock, they deserve that. They deserve that PE, and we're continuing to see tremendous earnings growth potential going forward. So we continue to stay with those names, but we also, within small cap, we diversify some into small cap and mid cap. In our income portion of our portfolio, we've stayed in the ultra short duration bonds. And the reason for that is we get such a high yield on the short end of the curve. With the Fed waiting, originally they were talking about 6 or 7 rate cuts this year. We're down to maybe 2 or 3, maybe a one and done. That's yet to be seen. In the meantime, rates on the short end of the curve are very high, so we can get a high yield there. And that's really the best place, we think, to continue to stay within our income portion of our portfolios.
Yeah. Understood. David Kudla of Mainstay Capital Management. Thank you so much. Great to see you.